Welcome everybody to the Trade of the Month for October 2019. And the two companies we're looking at today are Alliance Resource Partners and Cleveland Cliffs Inc. So let's take a quick look at what they are and who they are. Alliance Resource Partners got a 1.46 market cap, about a 1 beta. And it is a company that produces and markets coal, primarily to utilities and industrial users, a lot of steel companies, because it produces both steam and metallurgic coal. It's based in the US, and they have a little bit of oil and gas, and founded in 71. It's in Oklahoma, and it is in the basic materials sector, sub-industry coal. It's got 3,600 employees, and it's traded on NASDAQ. We've paired that with Cleveland Cliffs, which is traded on NYSE. It's got a market cap of 1.9 billion, so almost the same size. Higher beta, so you might want to take that into account. One of the things about this pair, it is volatile. We'll touch on that later. It's in the basic materials sector. It's in the steel subsector, and 2,926 employees. So why have we paired companies which are in different industry subsectors? Well, the important thing to remember here is that they are both producing the inputs to the steel industry. So over here we have metallurgic and steam coal. The description on Cleveland Cliffs, it operates as an iron ore mining company. I didn't touch on that. So it's not producing coal, it's producing iron ore. And these are in the United States as well. So they're very similar sized companies, similar regulatory regimes. They are basically very similar size employees, and one very similar market cap. If we look quickly at the financials and other financial statistics on both these companies to look at their valuation ratios, you're going to see that they're valued in a very similar fashion by the market. One produces metallurgic coal, goes into the steel industry, another produces iron ore. So you can imagine why we would pair the two. Those are very similar. So we've got a EV here of 3.7, a forward PE of 8, and EV to EBITDA of about 6. On Alliance, we have, let me just get this. We have a EV of 2.2, forward PE of 8, almost identical, and we have an EV to EBITDA a bit lower, about 60% of what we have on Cleveland Cliffs. So there might be some leverage here. We should take a look at that. Total debt to equity, you can see this is a highly levered company, which is why you've got that high beta, whereas Alliance is not. You can see a very conservative debt ratio there. So that's probably the reason why you see this big divergence in beta. Okay, so something to keep in mind on the volatility front, and you may choose to adjust your trade ratio accordingly. But those are the two companies. Now, what was the trading signal? The exit happened at the end of October, and we made some really good money on this trade, $2,200. Let's just quickly go to the pair charts to see the trade history. The entry happened on the 3rd of September. You went short Alliance at $15.59 a share, and you went long Cleveland Cliffs at $6.78 a share. Importantly, that was at a plus minus of entry stretch of 3.22. These are the top 30 U.S. equities pairs with a 2.0 entry and a 0.0 exit. So this was a big move up. As you can see here, here's your plus minus chart. Very big move up that triggered the trade. One thing I want to make sure you all think about when you get an entry like this, if you do your analysis and decide to take the trade, but you're getting in on a 3.22 entry stretch, don't write it all the way back down to 0. I mean, you can, but that's getting very greedy. If I'm up here at 3.22 getting in, I might exit at 1.5, 1.22, and I'll just point this out. Had you taken that philosophy, you would have exited this trade here for $2,000 profit in about 6-7 days. Otherwise, you had to ride it out. It came back on you, came back in, came back on you. So you thought you had great trades, you almost lost them. Then it came back in again. You thought you had a great trade, you almost lost it, and then finally it closed, crossing the 0.0 line. But don't get greedy. Anyway, we'll get into that in a second. Why did we choose this trade or this pair in the first place? Here's the backtest results over the last 3 years. You had 9 trades. This includes this last trade. You had 9 trades, You have an average correlation of 53%, which is decent. Co-integration is 0.94, so it's a co-integrated pair. Beautiful compound annual growth rate, 26.5%. Had you left money aside just to take the trades for this pair and not using any leverage, so just self-financing basis, that's a pretty good return. However, remember my warning about volatility. We'll look at that in a sec. Profit factor 5, max drawdown 20.7. So yeah, you've got a better than 1-to-1 risk reward, but just keep in mind it does have big drawdowns. If you're on 10,000 a leg, that means it's going to draw down 2,100, where that was the worst drawdown you had on 10,000 a leg. You had a 2,100 drawdown. Made over 11,000. We use very high commissions in this estimate because these are the top 30 we did in early August, end of July. And I don't know if you're aware, but Interactive Brokers for US clients has now gotten rid of trading commissions. So we were using 25 basis points for commissions and slippage estimate on every trade, and now you could reduce that significantly to say 0.1. But we had a net profit 10.26. This is an important number. Average net profit to trade about 1,100 and median about 1,300. So if your trade gets well above 1,300 bucks, you're well above the median. You might want to think about not getting too greedy. Percentage of winners 89%, which is awesome, and 30 days average in trade. So one of the other things we do is always look at the price charts when this happens. So it happened on September 3rd. Which is, we're looking at, here we go. We're looking at Alliance, and we can see that there wasn't any strange price action of any sort. So that would not have been why it was triggered. So then we go to CLF, and we can see this is September 3rd, big down bar. We have to check news and figure out why that happened. But that was what triggered the trade. Then if we look at the relative performance over the last year, we can see the co-integration at work, and why this is a beautiful pair to look at, PairTrade, because it comes apart, major divergence in relative performance, and then comes back together. Major divergence comes back together. Divergence comes back together. Divergence comes back together. Okay, so we're seeing that co-integration, and we're seeing the correlation. Comfortable pair to trade based on that relative performance chart analysis. So let's go and analyze it from a pair charts perspective for this signal. Signal happened here. So the ratio is, over the last year, it's at an all-time high and basically up against resistance. On the plus minus chart, as we said, it's 3.22, so it's above the highest. There was one here at 2.5, basically 2.49. So it's a bit of a breakout. We could look at that over 2-3 years, which would be a good thing to do if you think there's a breakout here. But I won't do that right now in the interest of brevity. And then on the percentage from mean, we have 16.77, which is just below the previous high percent from mean divergence, which is 17. So it looks like it's bumping up against resistance here on the basis of that 1 day's price move. And that might be something we want to have a look at and get our teeth into as a trade. What I also point out here is, okay, so when the ratio is trending upwards now from being at a minimum, you get a higher high here, higher high here. If you look at the RSI, you don't here. So you can draw these two as being higher highs, but the RSI is lower high. So we call that divergence, or I read this as divergence. That increases in our minds the probability that this ratio is going to turn around. So we like that a lot. And that would be a very big positive for deciding whether or not to take the trade. So what do we like about this? It's bumping at ratio resistance. The plus minus is at an extreme based on at least a year's history. It's bumping up against resistance on the percentage from mean, and we have a divergence on the RSI chart. Oh, by the way, that's also at a extreme reading. We're at 80 on the RSI. So, it's a good chart setup. What can we say? We like that. One other thing that I mentioned previously is volatility. I won't go into the volatility chart because everything would take too long if we analyze every element. But this, you can see here, it has a volatility of 4.16%. That's high. Anything over 2 is high. Call it average pair, between 1 and 2. And anything below 1 is like low vol, and anything over 2, 2.5 is high vol. We would definitely not position size this at 10,000 a leg if that's your standard risk sizing. We would probably cut this in half, position size it at 5,000 a leg. Okay, that's volatility. So let's just quickly go to the news. What caused this? If we go to Alliance Resource Partners, their press releases, remember the signal was on September 3rd. We got nothing. We got we have August 9th was an announcement of closing one of their mines. And then on October 14th, we have announcements of when they're going to have their third quarter earnings conference call. Okay, so nothing in there that would have caused the trade, and obviously the price chart reflected that for Alliance. So let's jump over to Cliffs Resource, Cleveland Cliffs. And yes, what do we see? We see that on September 3rd, there was an announcement. They declared regular quarterly and special cash dividend on common shares. So this is important because one of the things we always check is dividend payment dates, earnings announcements dates, and anything that would affect fundamental valuations. There's not a lot of detail on this, but what they did was instead of just paying 6 a share, they're going to pay an extra 4 cents a share, taking it up to 10 cents a share. Okay, so that's a nice little boost, but normally we would expect it to rally heavily on that. We don't have the time of this press release. You could dig deeper, see if this was before or after the market open, the market close, and I don't see that here. So we would check that in order to determine how that affects the price action that we saw. However, with that said, let's keep in mind something. Let me just dismiss that. Keep in mind something. If we look at the fundamentals, we've got a 3.3 dividend yield on Cleveland Cliffs, and Alliance Resource Partners, it's a limited partnership. It's built to dividend out all its earnings as cash dividends. It's a tax effective way for its shareholders. It's got almost 20%. They pay 54 cents a quarter, and we are going short Alliance in this trade. So that's something we really, really, really have to take into account, because that's the share price is only about 11, and they're paying 50 cents. So that could be a big chunk of any profits you might make on this trade. So we have to make sure we're not going to get caught by that dividend. And then we're going long on one with 3.27. So we need to check those dates carefully. So the ex-dividend date is on Alliance is November 6, 2019. This signal was on 3rd of September. We know that the average days in trade is about 30. Okay, so that gives us 9 weeks to the dividend date. So that's pretty comfortable. That's more than double the average length of trade. Up to you whether you would risk it, but certainly having more than double is not bad. Then on Cleveland, it's on the 3rd of October is the ex-dividend date. That says you're going to get caught by that normally on an average length of trade. However, we're long Cleveland, and we'll pick that up. We'll get paid that dividend. So that's something you might want to keep in mind as well. So let's just check. So those are the dividend dates. We've checked that. You make your own determinations, but we would have been comfortable with that setup. Then earnings dates, the January 27th, so it would have been September 27th, and the year was October, September, August, July 23rd. So on Cleveland Cliffs, we were fine. July, August, September, October. Yeah, we would have been. We had almost. We had 7 or 8 weeks here on earnings dates, and on Alliance Resource Partners. It's funny. Let's just check this. Their third quarter earnings came out on October 28th, and the trade signal was on September 3rd. So we had more than enough time. Okay, we had 8 weeks as well. So that's fine. So from an earnings point of view, it was a good trade to take as well, or it was a clean trade to take. So had you taken the trade, what happened? Let's just go back to our trade history here. So you're short at 15.59 of Alliance, made money. You close that out at 13.16, and you're long of Cleveland Cliffs at 6.78 a share, made money. You close that out at $7.28 on the 28th of October, and it came back to the zero line, and the trade made $2,205.34. let me point out, had you not been greedy and said, I'll take this when it hits below 1 or 122, you could have taken your profits on the 12th of September, $2,000, or if you left it even on a few more days, $2,400. But let's say this $2,000 figure, or even the $1,400 the day before, which is above the median net profit of trade, you were in this trade 1, 2, 3, 4, 5, 6, or 7 days, and you made $2 grand on a 10 grand a leg. That's 20%. And if you're levered 5 to 1, you're looking at 80% on your, not quite that much, you're looking at 50% on your margin in 6 or 7 days. So that's something to keep in mind. When you get in here and you see it come all the way down like that, don't wait for it to hit here. We wouldn't usually. We would take our 2 standard deviations of distance and get out, especially if we can do it that quickly. So that's the results of the trade. Happy trading, everyone. Hope you enjoyed the analysis, and we'll see you next month.